All right, let's talk about two of the most confused terms in all of trading, BOS and CHO. Nail this difference and you're trading with the flow. Mess it up, and while you're basically funding the other side of the trade.
And let's just start with a huge warning here. This isn't just some academic theory. Confusing these two ideas is one of the main reasons traders get caught in traps, and you end up being the liquidity, the very fuel for the big players you're trying to copy.
You hear traders throw these terms around all the time, right? BOS, CHoCH, often like they're the same thing. They are absolutely not. And this one little mistake is what leads to getting in way too late, getting out way too early, and chasing reversals that were never really there.
So you see these two kinds of breaks happening on the chart, but they tell completely different stories. Let's unpack them, and we'll start with the one that tells you the trend is still very much on.
Okay, first up, BOS, or break of structure. Think of this as the trend's green light. Its job is super simple. It just confirms that the trend you're already in is still going strong.
Now, what's really important to get here is that a BOS isn't some crystal ball predicting the future. Nope, it's a confirmation of what's already happening. It's the market basically shouting, hey, the smart money is still pushing this way.
So how do you spot one? It's actually dead simple. In an uptrend, you're looking for the price to smash through and close above a previous high. In a downtrend, you're looking for it to break and close below a previous low. That's it. A BOS is the market giving you the green light, saying the main move is still on.
Okay, now for the tricky one. Let's call it its deceptive cousin, the change of character, or CHoCH. And believe me, this is where so much of the confusion and honestly the danger really kicks in. See that word? Might? That's the most important word on this slide. A CHoCH does not confirm a new trend. It's just a little whisper, a warning shot that the momentum might be shifting. It's a yellow light, folks, not a red one.
So what does this actually look like on a chart? Well, in an uptrend, it's when the price breaks below the most recent high or low. In a downtrend, it's a break above the last lower high. This is the very first crack in the trend's foundation. It's the first time the market failed to defend its structure, and that hints that the bulls or bears, well, they might be getting a little tired.
So let's just put it all side by side to make it crystal clear. BOS is your green light. It confirms the story we're already in. CHoCH, on the other hand, is the yellow light, a warning that a new story might be about to start. And jumping the gun on that yellow light, that is exactly how most retail traders get trapped.
This brings us to the big question, the institutional trap. If this is all so clear, why do so many traders walk right into it? Well, it's because they're seeing the pattern, but they're not asking why the pattern is there in the first place.
So why is this little yellow light so dangerous? The whole answer comes down to one thing: liquidity. You have to understand what the big institutions, the market movers, need to get their huge orders filled. And a CHoCH, well, it's the perfect way for them to get it.
Think about it. A huge bank can't just slam $1 billion buy order into the market. They need someone on the other side selling to them. So what do? They engineer a CHoCH to trick retail traders into thinking a reversal is happening, so those traders start selling, and that becomes the pool of liquidity the institutions can buy from. This is literally the institutional playbook, step by step. First, you've got retail traders doing what they're taught, placing their stop losses right below a higher low. Perfect. Next, the institutions nudge the price down just enough to break that low. Boom, you have a CHoC, and the trap is sprung. Reversal traders see the CHoC and pile in short. At the same time, the stops from the early buyers get hit. Now you have a huge flood of sell orders. And what do the institutions do? They scoop it all up. They use all that selling as fuel to fill their massive buy orders. And then the real move begins. Price rockets back up, continuing the original uptrend and leaving everyone else in the dust.
And this is why you see it happen over and over again. Price dips, creates that little CHoCH, and then just rips in the original direction. That CHoCH was never an entry signal. It was a test. It was a liquidity grab. That's all. Okay, so now that we know the trap exists, we can build a simple rulebook to avoid it. This is about shifting your thinking from just seeing patterns to understanding the flow of money.
Here is your new mental model. I want you to think of it like a traffic light. CHO is that yellow light. It means slow down, look around, analyze what's happening, wait. BOS is the green signal. It means go, participate, execute your plan. The road is clear. So adopting these rules can totally change your trading. A CHoCH is your cue to pay attention, to observe, not to jump in.
A BOS is your signal to participate, to get involved, because you're aligned with the big money. Remember, that first retest after a CHoCH, it's almost always a trap to get more liquidity. And a huge one, trade away from where liquidity was just swept. Don't be the fuel for their fire. Once you start thinking like this, you're not just reacting to squiggles on a chart anymore. You're actually understanding the game.
Look, if you remember only one single thing from this entire explainer, let it be these 4 words. CHoCH warns, BOS confirms. Say it to yourself. Write it down. This simple idea is the bedrock of clean, logical trading.
So, the real question is, now that you can see the trap, how are you going to spot the real move? If this explainer helped clear out market structure for you, you're going to want to subscribe. Every single analysis we do here is designed to cut through the noise and give you that kind of clarity.